Hey guys, welcome back. This is Dave and I'm here with another video on Rocket Lab. This time we're going over really diving deep into the numbers and making a basic valuation model of the company and how we can think about how to value it in the future. A lot of people with these space companies just get extremely excited about the technology. They're like, oh, these rockets are so cool. I want to own this company, which I get completely. And I'm also like that. But we need to make sure that we're buying it at the right price and that we think it's going to go up in the future, not just because we like the management and like the technology, but also that it's currently priced at a reasonable price. That's why when it ran up right after the SPAC, went public at 10, went all the way up to around, I think, 20 or maybe it was 17. You really have to have these models in place to know, okay, this is a price I think is fair and I'm willing to pay, and don't just go chasing it because you like the company. That's how you get really hurt. So it started off around 17 and now we're down at $3.09 a share. So while I think it's an amazing bargain where it is now, I don't think it was an amazing bargain at $17 a share. And that's why you need to do this math and do these charts to figure it out. So let's hop over to the charts and dive into it. All right, so we're hopping over into the spreadsheet where we made our Rocket Lab EPS valuation model. It's very basic. A lot of people make a lot more advanced type stuff. So I'll just go over everything for you. I threw in the 2021 numbers for Rocket Lab. These are obviously official and final. So in 2021, we had revenue of 62 million, cost of goods sold was 64 million, so then obviously that was at a loss. SG&A was 58 million and change, and R&D expenses were 41 million and change. Now, bear in mind all these numbers are in thousands, so that's where you get the million from. And then from here, we're going to project out from 2022 all the way to 2027, all these numbers. And we're basing this off a few different things, mostly just comments that the management team at Rocket Lab has made in the past, and their presentation and prospectus when they first went public back when they completed their SPAC deal. So things obviously change and can change. That's why we'll watch every quarter's results extremely closely to make sure they're on track to meet these numbers. And if they're not, if they miss their targets, if they introduce lower targets, we'll have to update this model as we go and change our valuation, because even small margin changes at this point can have massive implications for the future. So first thing you might notice here in 2022, we have revenue of almost 200 million. And revenue in 2021 was only 62 million. And you might be thinking, like, that's an insane jump. That's almost like 4 times increase from just 1 year to the previous. Like, that can't be right? But it kind of is, actually, because back in 2021, we had all sorts of problems from the COVID pandemic. We really didn't launch very much. So, of course, our margins were brutal. We didn't make a lot of money, and it was a bad year for the company. These numbers, we already have the Q1 results in. They made over 40 million in Q1 alone. So all of 2021, they made 62 million, and in Q1 alone of this year, they've already made 40 million. So well on track to beat that 62 million number. But where do we get the rest of the numbers from for the remaining 3 quarters? Well, at the end of the Q1 earnings call, they said their projection for Q2 revenue was around $51 to $54 million. I took the middle of that, around 53 million for your Q2, and I just, to play it safe, assumed no growth for the rest of the year. So I took 53 million for the remaining 3 quarters, and that kind of got us to our starting point of just shy of 200 million. Of course, that's kind of conservative. Hopefully, anyway, they'll continue to grow past Q2, but when I'm making these valuations, always want to play it extremely safe, extremely conservative. If anything, I want to err to the downside, not the upside, so that I can feel safe with my investment. Now, back when they went public, they projected some numbers here, as you can see shaded in the yellow, from their investor presentation. They projected basically 1.6 billion in revenue in 2027. That's a massive increase, right? So we're going from 62 million to 1.6 billion. It's insane increase. Out of that, we had about 500 million in EBITDA. EBITDA stands for earnings before interest, depreciation, and amortization. And then, of course, you have to back out various expenses and things of that nature. So what I kind of did is I tried to play it more safe with my own estimates. And of course, you can plug in your own numbers to any of these fields and change it as you think they'll execute. I played it a bit more safe, so I gave them like 1.2 billion in 2027 revenue. That's still absolutely insane growth, phenomenal growth, really. We're looking at like almost probably over 40% growth per year if you annualize it. So not a lot of companies can do that kind of growth. It's extremely ambitious. We'll see if they can execute it. Clearly, the market doesn't think they can right now. That's why we're trading at such a cheap price. But we'll get to that later. So I gave them 1.2 billion in revenues, cost of goods sold. That's how much it cost them to make these products and services they're selling, basically like how much the margins are going to be. And they've said down the line, they plan to get to 50% margins. So that's why we have cost of goods sold around 615 million. And then we have the SG&A, selling, general, and administrative expenses. We have around 92 million, and R&D expenses for the year 2027 are 85 million. Of course, these are all estimates, and again, there's no way they'll all be right. There'll be some variance for sure on all of them, and I'll just kind of keep track as we go along and update the model as we go. They have said that the Neutron is likely to cost about 250 million in development, which is extremely cheap to build a new rocket, but 250 million is still 250 million. So if we add up all these years, we'll get the cost, the R&D costs, around 400 million. So that leaves 150 million for non-Neutron related expenses, as whatever else Peter Beck and his engineers are cooking up. There's always R&D going on. And to be honest, I like R&D to be high. I would rather have R&D higher than SG&A, because that means the money is going towards, things that will make you more money in the future. Whereas SG&A, that's just like administrative, cost of doing business, but it's not necessarily going to increase your revenues in the future. So you want to try and keep this low. Again, pretty conservative. So I have SG&A going up. I kind of took some averages from other companies based on how much it tends to go up year over year. Came out to about 8% per year increase. So that's why I ended up at around 93 million for SG&A. R&D increased it a bit more because I do want to see it go up more as well, and that's where we landed. But these could very well be way off. They could do really well at controlling the SG&A. They could invest more heavily in R&D. I wouldn't actually be surprised if we saw a lot of this kind of front-loaded as we get going on the Neutron. So maybe less R&D on the back end, more R&D on the front end type thing. But this is roughly where we stand for the projection. So once you take the revenues minus all this out, we come to an EBITDA number of $438 million. That's, again, earnings before interest, depreciation, amortization, which is just basically the value of your assets going down. You have to count for that. So all the equipment and machines in your factories, all your launch pads, hardware, basically everything you own, it all goes down in value, just like a car you own might go down in value. So we have to account for that on the calculations, and so then we take out depreciation, and we get earnings after depreciation of 438 million. Sorry, earnings after depreciation of 400 million. And then your nominal tax rate, we're using 21%. Of course, it can vary by state and things like that. This is just kind of a generic number. So then after tax rate, you subtract that out as well. We're looking at $354 million, which is basically now your net income, because we've subtracted out all these various costs. We started off with, revenues of 1.2 billion, and we're down to profits basically of 354 million. I also did the calculations based on roughly what their numbers were from their presentation, in case they did hit that exactly. Then we'd be looking at a net income of more like 403 million, as opposed to the 354 I gave them in this valuation. But that's not it, because this is money that they'll be making in 2027. And of course, money today is worth more than in the future. Like, I'd rather have $500 million today than $500 million in 5 years. So how much extra is it worth for having the money today as opposed to in the future? I put in 12%. A lot of people use 10. You can have different numbers for that, but basically I'm doing 12% annually is the premium I'm putting on this. So for every year we go further in the future, the money I'm willing to invest will basically go down 12%. So next we calculate the terminal value of this earnings in 2027, which is basically, so now we have to calculate the terminal value of this earnings number in 2027, which is the value it will hold in 2027 based on a price to earnings multiple. And I went ahead and gave it a multiple of 25. I feel like it's pretty reasonable. So you can look at a few comparables to try and get a sense of where the multiple might sit. But basically how it generally works is that the faster a company is growing, the higher multiple investors are usually willing to give it. That's because they expect it to keep growing faster in the future. Whereas if a company is not growing at all, if it's completely flat, you're not willing to pay extra for future growth because there is no future growth, so it's a lot lower. A relatively stable company that's growing at a slow rate, that's quite mature, might have a multiple of 10 or 8 even, and you get a lot of banks in like maybe 12 range. Whereas a fast-growing company could have a much higher multiple. And I tried to find a range of multiples to compare with to see what would be reasonable to give Rocket Lab. It's very difficult because this is a very brand new growing industry, that space and launch. And most of the companies in this industry are not like pure plays. I put down Boeing here to give an example. They've historically had a PE of around 22. This is in the past because right now they've had all these disasters with the 737 MAX airplane and all this other stuff. Problem with this is, of course, that this is mainly based on their airplanes in their flight business, not their space business, which is a smaller part of the company. Northrop Grumman is also an old school company. It has a price to earnings multiple of 13. On the other hand, Maxar is a relatively newer player. They've turned positive. They are not in launch, but they are in the space industry, and they have had a multiple generally of around 30. So that's a little more on the higher end. And then just for comparison, we have a fast-growing software company called Intuit. I know it's a completely different industry, but it's one that has been growing very fast year over year, and they have been given a multiple of 50, so even higher than that. So when you change this number that you give the the earning multiple, that has a massive effect on the value of the company. I also looked up aerospace industry averages. There's a few sites that average out price to earnings based on industry. Simply Wall Street has said in the past it's around 22.6, whereas Equivista has said 33. And why are these two so different? Probably different time frames. Aerospace industry average here from Simply Wall Street is a 10-year average. This might have been more recently. We might have had multiples run up, or they just pick different companies and average them out. There could be a whole host of reasons why. They also include defense companies in this, so military contractors and stuff like that can skew the numbers. Usually it's useful to see what other companies in the same industry are trading for in terms of multiple. So I gave it 25. Again, I think this is extremely conservative. If it really is growing at this pace in 2027, honestly, it's probably a lot higher than a 25 multiple. But we're being safe here, so we're saying 25. So that means if we multiply our $354 million in profits or net earnings by our multiple, we'll get a terminal value in 2027 of $8.8 billion for the whole company. Now, of course, as I said previously, that's in 2027, and we have to decide what are we willing to pay today for that potential future valuation. So if we think in 2027 it might be worth $8.8 billion, what are you willing to pay for it today? And as I said, that's where you use this discount rate coming in. I use 12% per year. We're going to cut off what we're willing to pay. Some people use 10. If it's a higher risk, you might want to cut off even more. This is a number you can edit yourself as well. So you could make it even 15 if you wanted. But that left us with a present value of about $5 billion. Now we have 463 million shares outstanding. So we divide that total value by the number of shares, and we got a current value per share of around $10.80. Whereas obviously, if you do the math, the value in 2027 would be $19. So that's how the numbers came out. Now, of course, we can change this in any number of ways. If I pop in let's just for argument's sake, let's pop a 50 multiple in here. You can see that massively changed the valuation, and a lot of this depends on the macro markets, on if people are really bullish about the markets. It also depends on interest rates and things like that. So let's say, just for the sake of argument, in 2027, Rocket Lab is being given a 50 multiple by the markets. That means the terminal value in 2027 would be all the way up to $17.7 billion. We subtract out our 12% annually, we end up with about being worth $10 billion today, and then the current value would be all the way up at 21. Now that's extremely bullish. You have to be a real believer to believe you'll get these values. I'm not saying it's impossible. The company really needs to execute on this insane level of growth that they've forecasted. If we put it back to maybe 30, then we have a terminal value in 2027 of $23 a share, which is more reasonable, which brings the current value down to about 13. So this is one of the reasons why you really need to do these numbers and make sure you're buying at a good price, because when it went public around $10 per share, and a lot of people got extremely excited. They bid it up. I think it went close to 20. Now, if you did this calculation, say like this, and you see current value per share $13, then you're not going to pay $20 a share for it when it first went public. A lot of the time when these things go public, there's a ton of excitement. Things get out of hand. It shoots up probably more than it should. So I know I'm as guilty as anyone of just getting excited about the technology and how cool the company is, but that's why we have to do these numbers, even though it is a little dry. You can also, of course, change how much SG&A you had, how much R&D, and the margins are a big one, of course. They could make this much revenue, but the cost of goods sold could end up being way higher than you expect. Let's say like 900 million. $900 million in the future. And then if that happens, we're looking at about 475 a share being fair value today. So you can plug in so many different numbers and get so many different outcomes. That's why you really have to watch closely and make sure they're executing on these projections they've given. So far they have been, although some of this growth has been fueled by acquisitions. They have a pretty good sized balance sheet after the SPAC. They've acquired, I think, 3 or 4 companies since then at least. And those companies are profitable companies that are adding to their revenues. So that's helpful, but obviously it's not completely sustainable. You also might want to think about whether they'll issue more shares in the future to raise more money, which could dilute you further and make your shares worth less of the overall pie. Another thing we can do is go by their original number for 500 million in EBITDA instead of my lower projected number of 438 million, just for argument's sake, to see what that would come out to. So that means terminal value 2027. We're now looking at this one, 402. Okay, so that changes our terminal value for the whole enterprise to about 10 billion in 2027. And that brings our current value per share up to $12 and the terminal value per share up to $22. Of course, if you keep it like this and then also change your multiple even higher, then you're looking at even bigger numbers. So if you put in a 30 now, we'll go up to 26 in 2027, and it's worth, say, 15 now. If you could throw in whatever you want, 40. Now we're talking $35 per share in 2027, which is obviously over a 10x from here. But going back to what we had, trying to be a bit more conservative and a bit more safe, we're still talking $19 per share here in 2027 if the team can execute like they've projected or near what they've projected. So I know it's a big ask because they have massive growth, but $4 per share right now, $19 per share in 5 years. So that's basically a 5x return, which is extremely good. If you're any investment, you'd be happy for most people would be happy for a 2x return in 5 years. That's about 20% per year. But if 5x return in 5 years, extremely good. And then obviously if you increase these numbers or play with it, you end up at, potentially even closer to 7 or 8x, or who knows. It all depends on revenue and multiples. But I think it's if they execute, it has potential to be a really great investment, and that's why I have done this valuation. So to just wrap up this video, this has been an extremely basic model of the potential financials of the company for the next 5 years. There's a lot of different ways to value companies. I can't say this way is any more valid than any other way. You can do a DCF on it. You can look at different metrics like EV to EBITDA. But this was just looking at price to earnings and projecting out. Having said that, looking at our model, I do feel pretty good about this investment in terms of a risk-reward basis. We do really need the team to execute on their growth. If they don't manage to grow near what they say they can, then all this is for naught, obviously. So that's why we're going to watch closely every single quarter, and I'll be sure to cover every single quarterly earnings, let you know what I think, if we're still on track, if we're missing it, and we're going to have to revise our numbers down. But right now for me, I'm definitely a buyer. I'll buy more if we drop down towards the mid threes, especially. I think the risk reward there is good. Let's not kid ourselves. It is a riskier stock. I mean, anytime you're buying a company that's not yet profitable, it's always going to be risky. If you add that into the fact that we're talking about rockets here that can explode for any number of minor reasons, extremely competitive industry as well. There's all sorts of new players coming online. Relativity has a very exciting new rocket that we're going to cover soon called the Terran R. We've got Astra, of course. I'm going to talk more about them in the future. All sorts of new players coming online. Extremely competitive industry, which is great for space enthusiasts as competition leads to innovation. But when you're an investor in the industry, it can be difficult. So you always have to keep that in mind as well. But having said all that, I think the future could be bright for this company. I do believe in Peter Beck. I believe in the team. So far, they've executed well. And I'm really looking for a 5x plus return on this investment. So let me know what you think. What level have you bought your shares at? And what kind of a share price do you expect to see in 2027? I'll talk to you guys down in the comments below. See you next time. Bye.